Well, hi there, everyone. Happy Thursday, February 6th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a continuing snowy Redmond, Washington. Thanks for joining me every weekday after the close, and apologize for the late kickoff here. Actually, in downtown Redmond, just had lunch with my good friend Grayson Rose of Stock Charts, and doing this from the Stock Charts office. So apologize, we got a little too engaged in the lunch conversation, so I lost track of what I needed to kick things off here. But I appreciate you joining me now as we review what has ended up being a pretty decent day in terms of the major averages. A pretty uncomfortable day after the hours with Amazon leading the way with a big earnings miss. Again, a week like this, you're seeing some of the leading growth names struggle on the earnings side. While stocks like Meta just continuing to show strength, stocks like Amazon now, questionable after earnings. You're starting to see this real bifurcation within the Magnificent Seven, right? Within that Magnificent Seven group of stocks. We might have to no longer call it the Magnificent Seven and Friends, maybe the Magnificent Seven and former friends, because you're starting to see some real differences between the stocks that are still working and the stocks that are no longer doing the moves that they were doing before. A lot of earnings to unpack, of course, today. So we're going to go through a bunch of charts here. We'll go through the market recap. We'll look at the heat map, and then we'll figure or focus in on some of the individual names reporting earnings, some of the themes as well. As a reminder, I can see any questions you put in on any of the platforms upon which we are live streaming, Facebook, LinkedIn, YouTube, and X. I appreciate so much you joining me live. Those of you that are doing so, please ask questions as they come up as we're going through the content, and I'll get to a question or two at the end of the live stream before we wrap for the evening. And if you're watching the replay, by the way, on our YouTube channel, I appreciate you as well. Drop a comment there, a question as we're going through the content, because we will do a all mailbag episode tomorrow, and I would love to feature one of your questions on the show. All right, let's get to the market recap here. The S&P finished about 1/3% higher. You can see from sort of the little 2-day preview chart, big bunch of that gain basically happened from 2:30 Eastern to 4 p.m. Eastern. We did finish today just above 60.83 for the S&P 500. That's up just over 1/3%. The Dow actually finished in the red, down about 0.3%. Leading the way lower. The NASDAQ was up about 0.5%. So growth over value back to being the theme we're observing here today. Mid caps were flat. Small caps were actually down slightly, about 0.4% to the downside. The VIX continues to drift lower. So again, if you're looking for a big red flag from volatility, I don't have one to show you. Volatility is telling you things are fine. Credit spreads are telling you things are fine. So as much as this market, I feel like it is really giving us a little bit of everything, kind of mixed signals here, right? Stocks breaking out. We'll look at things like tobacco stocks today, just ripping to the upside, continuing these uptrends that have been persisting from 2024, just continuing like nothing else is happening. At the same time, breadth and momentum deterioration, names like Alphabet or Amazon missing earnings, and all of a sudden that creates a complete disaster of a short-term move in the on the technical side. But volatility remaining fairly muted. That's what we continue to see here. All right, looking at fixed income markets, the other asset classes, you can see the yield curve generally drifted higher today. The 10-year yield finished around 444, kind of a magical number, up slightly from yesterday. Long bond yield, 5-year points, all kind of drifted higher a little bit. Rates have been chopping around quite a bit. We highlighted in the last couple shows, we looked at the 10-year treasury yield. We looked at the TLT yesterday, breaking through trendline support as sort of a new look. As bonds starting to outperform stocks, at least in the short term, which is kind of a different vibe than we've had for quite some time. For today, bonds really not following through much, essentially flat for the day. Same can be said for the US dollar, ended about where it finished on Wednesday's close. Gold actually did drift slightly lower. We've been tracking this continued uptrend phase in the price of gold. For today, though, down about 0.3%. Silver slightly higher, copper higher as well. Crude oil prices a little to the downside. It's kind of mixed results on the commodity side, but no real significant moves looking at the commodity ETF space. Cryptocurrencies, I mean, listen, Bitcoin continues to not impress, continues to languish below that 100,000 level. As much as we want to debate the long-term investability of cryptocurrencies and things like Bitcoin, I would say in the short term, you're definitely seeing distribution here. Bitcoin now, I feel like a far cry away from previous all-time highs above 108,000. That's a long way away from where we're at now, around 96,300 as we record the show, drifting lower through the course of the equity trading session. Ether price is now well below 3,000, currently just below 2,700. That's down another 4% today. And you can see most of the top 10 cryptos tracked on the stock charts platform all in the red today. You know, the breadth overall, while the breadth I would say has lacked follow through, right? We've had a noticeable breadth divergence with the market moving higher December, January, February on weaker breadth and weaker momentum. We are seeing in the short term some fairly strong breadth numbers, at least this week. We're seeing days where a lot more stocks are up than down. That's the advanced decline data. Here we're looking at what you call sector breadth. How many of the 11 S&P sectors were in the green? The answer is 8 out of 11. That's good. That's better than half. We can see on the top, though, financials, the XLF, number one, up 0.8%. Consumer staples, industrials, communications, services, consumer discretionary, all essentially tied for second, all up about 0.4 to 0.5%. But consumer staples getting the number 2 seed. On the downside, only 3 of the 11 S&P sectors were red. Energy back at the bottom of the list, down 1.8%. And again, I don't want to beat the dead horse of energy, but I would say, again, as we mentioned many times, you know, for me with something like energy, it's a call on crude oil, which I think makes sense. I mean, energy companies are essentially tied to the value of crude oil prices. Until crude oil kind of gets a meaningful break above $80 a barrel at this point in terms of where we're at in the technical structure, I think energy stocks are not a particularly good bet. And we've seen some interesting rotation at times where it felt like things were going to go into energy. Today, kind of right back where we started, down another 1.8%. Healthcare, number 2 from the bottom, down 0.9%. Utilities were essentially flat for the day, just down slightly from yesterday's close. Again, we're not formally updating our Keller market trend model until Friday's close. That's what we do every every week. At the end of Friday's close is when we update the model formally. This was a model we designed years ago to just think systematically about market trends on 3 different time frames: short-term, medium-term, long-term. Earlier in the week, if you have this visualization up on your stock charts homepage, you would have seen that the short-term models had turned negative for all of these major U.S. equity indexes by today. Short-term turning back positive. The medium-term was actually negative, I think, for small caps. I want to say earlier in the week, now back up to green. So during the week, we've seen a bit of short-term weakness, but again, day like today, we're finishing strong and having nice upside follow-through. So for now, no expected change in the market trend model. Again, as we say, there's plenty of game left. We'll see what happens tomorrow. Sorry, I just completely went off the dashboard there. I don't know why I'm doing that. Who's driving this thing? I am. Hold on a second. We're going to go back to one more piece here. Okay, now I just killed it all together. Oh, no. Come on, guys. As we go back to the breadth indicators, as I'm waiting for this to come up, here we go. The breadth indicators were sort of mixed, right? Sort of flat. Here we go. Advancers, decliners. Again, on my stock charts login, I actually have this running at all times. This breadth widget looking at advancers, decliners. I'm so glad that this was added last year because it's something I would refer to all the times and try to find in different places. And having it right up front, I think, is brilliant. You can see it's slightly higher for most of these on advancers versus decliners, but not much. I mean, they're pretty close. And to be honest with you, small caps more decliners than advancers. Same for the NYSE, which basically is flat. S&P slightly higher, but these are pretty much coin flips between the two. So essentially, some stocks were up, some stocks were down, but no real, I would say, significant change to breadth indicators right about there. Excuse me. Looking at the leading growth names, what we have called the Magnificent Seven and Friends, but now I'm skeptical that is a great name for this list. And I've had I saw earlier on the chat here the Miserable Seven, Titus Ryder. I don't think that's a bad way to do it, but they're not all miserable though. It's almost like the Mixed Seven. It's the the mediocre 7. There's some okay, but some not. I don't. We'll keep going. If you come up with an alternative to imply that there's some more, it's a mixed bag at the moment. The mixed bag 7 is what we'll go with. That is where I think we're at. Nvidia up 3.1%. Amazon, and don't get too excited because things don't look as good in the after hours, but going into today's earnings report, up 1.1%. Meta also up 1%. Tesla continuing to give back some of its previous gains, down 1%. Alphabet flat for the day, and Apple slightly higher. All right. Excuse me. Still not completely over, but feeling better. That's good. Still not 100%, but good enough to get through a show, I will hope. And I appreciate you guys hanging with me as my whole family kind of struggles through, as I feel like most people are in January and February, getting through some flu-like symptoms. We'll get through there, guys. All right. Looking at the heat map here. So again, I'm going to kind of go stream of consciousness through what I see. And again, what I'm doing when I show you the market carpet and kind of go through it is what I hope you do when you bring up this kind of visualization. Initial takeaway. So I'm immediately drawn by the negativity in the healthcare sector. Where's my mouse? Here we go. Because besides Eli Lilly, there's a lot of red there. And that's the most concentrated red that I see besides down here in the energy. So this is definitely not a great day for healthcare or energy. That's sort of my initial takeaway. Second thing would be kind of the muted reactions. Excuse me, for some of the names like Alphabet, Broadcom, Apple, not big movement kind of days. These were kind of sideways, wait and see kind of days. I'm also drawn by the strength in Nvidia, especially the strength in the financial sector with JP Morgan up, Citigroup up. I mean, these are big names having pretty decent upside follow-throughs. The XLF was the top sector out of the 11, if I remember right. And some of those leading banks, I mean, just really strong charts from a technical configuration, kind of long and strong up and to the right kind of names. I did grab JP Morgan, I believe, and put it on the for the chart review here in a few moments. But the other big theme I would say would be some of the bright red here in technology: Qualcomm, Salesforce, Accenture, IBM, even some of the smaller names: Qorvo, Skyworks, Zebra, CDW. These were all names that were down pretty good today. Something like Salesforce down 5%. And again, that's not the end of the world, right? We're still kind of hanging in there. We're not breaking down yet, but talk about a stock that's no longer going up, right? I mean, and again, not to digress, but it's my show. I can do what I want, I guess. If you look at CRM, it's not, and I think this is the problem for the markets here in, early February of 2025. Charts like CRM looked really good in the second half of last year, right? First half of last year was kind of mixed. The latter half of last year was remarkably strong. And even though we pulled back in December, it was a strong 6-month period going into the end of the year. But if you look at what's happened in the new year, we're not making new highs anymore. We actually just tried to do that about a week and a half ago and failed to eclipse the December peak around 370. We're not breaking down yet because we're still holding 315, which was the swing low from about a month ago, early January. We're literally kind of in the middle. The RSI on a lot of these stocks is going to be right around 50 because we've had some up days and some down days. And a measure of momentum like RSI is trying to show you what we're doing right now, momentum-wise, versus what we normally do. How is the stock trading? How is it moving from day 1 to day 2, day 3, relative to what it normally does? Are we seeing extreme moves to the upside or downside? When the RSI is right around 50, it tells you up and down days are kind of even. There's no real extreme momentum on either side. It's kind of neutral. And so that's where we're at, right? Semiconductors, the SMH, the QQQ, the S&P, CRM, and however many stocks it can come up with are no longer going up. They're not breaking down a ton. It's not like an end of the world chart, like, obvious sell kind of chart. It's neutral. And as much as you may not want to hear it, you wait. I think you have to wait in that sort of environment. From a technical perspective, if you think about it, I mean, back in the day, I remember coaching analysts and you were taught, buy, sell, hold, right? Are you bullish, bearish, or neutral, right? A neutral rating is a hold rating. And as much as I would say Wall Street generally does not use that kind of rating system particularly well, and they usually do 5, like strong buy down to strong sell. There are way too many buys relative to what normally outperforms. So we're way too optimistic in general, based on that, the distribution of those ratings. But if you think about what the idea of a hold rating is, most people interpret a hold rating as like a sell, but you don't actually stay sell, so you say hold. What the definition of a hold rating was if you own shares, there's not enough to tell you to sell it yet. It's not broken, it's not horrible, it's not an obvious get out of the way, but it's just not great, right? So if you have new money, would you put new money to it? No, I'd hold my current bet and just see if things improve. And I think that's what, these from a technical perspective are kind of hold ratings, right? They're kind of sideways. They're where they were 3 months ago, and we've chopped around, but we haven't made any directional movement. Now, having said that, while CRM and other charts look like that, there are others that look very different. And I think that's what we'll try to highlight as we get to the chart review. What else stands out? I think that's good for now. Again, as I'm bringing this up, what I'm doing based on where we're at in the cycle is always thinking very much about these defensive sectors over here, which kind of in the right half, bottom half of the market carpet. Consumer staples, real estate, utilities. These are kind of pure defensive sectors. Those things probably do well if institutional investors are getting nervous and want to get out of the way and ride out a period of market uncertainty in a low volatility area of the market. When you see more and more green in there, when you see other things red, but those defensive sectors less red, that tells you that rotation is happening. The RRG, which I probably don't feature nearly enough on this show, does a brilliant way of, I think, demonstrating that. And I would encourage you to keep that in mind. Keep a wary eye on that part of the heat map. I didn't grab any travel tourism names. Look at Marriott making a new all-time high. Hilton making a new all-time high as well. Breakouts are out there. All right, let's continue on and complete this this process of chart this by looking at the chart review portion. We've got the S&P, and then I really didn't do any other macro charts, if I remember right. A lot of individual names, kind of getting through the bulk of earnings season here. I think 18% of the S&P 500 members are reporting this week. It's pretty busy. In a half-hour show, I have barely enough time to get to most of the names that are reporting. So I would encourage you to use scans and use alerts and use platforms like stock charts and others that show you movers to see what's moving up and down, and just make sure you're aware of the big movements that could have a significant impact on your portfolio. Looking at the daily chart of the S&P 500, as we mentioned with the chart of CRM, I think this is a consolidating chart. We're getting closer and closer to the upper boundary of that range, right? The green line here is 6,100. That's the all-time high we established the first week in December. That was a level at which we failed. Third week and fourth weeks in January. Now here, as we wrap the first week in February, we're right back up at those previous highs. By the way, had a really good interview earlier today with Steve Kress, who's the head of quantitative research for Seeking Alpha, and I've talked about Seeking Alpha's products before on my YouTube channel. This is a really good opportunity to sit down with Steve, who designed the quant rating that they use, runs the Alpha Picks product and other products for Seeking Alpha. And the reason why I'm mentioning this is we talked about, combining sort of the big picture environments with modeling and scanning and looking for individual stock ideas. And one of the things that we laughed about earlier today was the fact that if you look back in market history, we've had plenty of 10, 20, even more percent corrections. Market history is filled with those. And even in very bullish years, you'll have a 10, 15% correction at a time. That's pretty normal. What you have to remember is 100% of those corrections have been completely retraced all the way back up to their previous highs, as we see yet again today with the S&P that made a December peak around 6,100. We got down to around 5,800, a little less. And here we are right back up to those previous highs. So being bearish can be a very profitable short-term strategy for equity investors. As a long-term thesis, you are pretty much guaranteed to be wrong. As long as your runway is long enough, the market tends to recover because the global economy continues to grow. And I don't see that necessarily. I don't see that story changing until well past when I am on this earth. So for now, big corrections are usually great buying opportunities. Having said that, we're not in a correction at the moment. In the short term, the S&P is recovering very, very well to those previous highs. S&P over 6,100. Generally speaking, that's a constructive development for sure. Anytime you see a break to new highs, I immediately go down to the momentum. I immediately look down to the breadth conditions and see, is that higher high in price supported by stronger momentum and stronger breadth? I think one of the challenges for the S&P 500 and the NASDAQ in mid-January, which is the last time we pushed above 6,100, we did so on weaker momentum and weaker breadth. And even now, we're still below the momentum readings we were from a couple weeks ago. Last time we pushed above 6,100. So market going higher on downward sloping momentum. That's called a bearish momentum divergence. It's a classic sign of a market top. Does not guarantee it because the market can and it certainly has gone higher after breadth divergences. But it tells me to be very wary and skeptical of further upside for sure. All right, that's it for the macro charts. Let's look at a bunch of individual names. I promise you I'd keep NVIDIA on the list and semiconductors until I think there's a significant, breakout out of the range that we've established. Just want to once again point out, as I will continue to do every episode until it's no longer true, we had the gap lower on NVIDIA on earnings end of January. You can see that from there. And sorry, that wasn't earnings. That was the DeepSeek AI announcement. NVIDIA gets dinged on a Monday in a pretty big way. For the entire rest of the last week and a half, we have literally remained in the same range as established on that gap day. That tells you how, from that moment on, there has not been any incremental evidence or support or shift in sentiment away from the initial shock of, there's this new technology. How much of an issue is it going to be? It felt on that Monday like that was just going to be the beginning. That was the end of NVIDIA's business, and the thing's going to go to zero, or at least a lot lower than it was. Others said that was just an overreaction. You need to buy NVIDIA and ride it back because it's going to recover those immediately. Neither of those scenarios has actually played out. Scenario 3, which is we just kind of sit there as investors try to get their head around this, seems to be what the market is telling you. So even though there's this big disruptive new player based out of China, even though there was a lot of questions about the amount that companies like NVIDIA are spending and the importance of NVIDIA's chips to the future of AI. Apparently now it's not gotten worse and it's not gotten better. We're still waiting and seeing. This is when I talk about the markets in a sit on your hands kind of moment. This is what the chart looks like for me. Again, through the course of this week, getting better, and that's undeniably so. We get back into this range. I think that would be pretty encouraging. But for now, we're still waiting. Now, the SMH, the SOX, a little more range bound still. They didn't get the gap below the range. The gap that we had on that Monday actually took us to the lower end of the range, excuse me, that we established in the fourth quarter of last year. We're still trading between the early October low and the mid-October high. We've had failed attempts to get above or below that range, and we continue to kind of sit right in that point. As of today's close, I would argue we're literally at the midpoint of those two extremes. We are sitting on a dead flat 50-day moving average, and the RSI is about as 50 neutral as you could finally come up with. This is a market telling you we don't know yet. We're not sure, but for now, the market's fairly priced based on the growth prospects for semiconductors. To be determined, right? What happens from here? But I'm keeping a very close eye on that framework because at some point, the SMH exits that framework, and I think that's going to be the next big technical theme that you want to make sure that you are aware of. So here's what Alphabet looks like this week. Here was the gap lower. Excuse me, I'm sorry. On Tuesday, we had the gap down earnings. Yesterday, this is Tuesday, they reported after the hours. Wednesday, we have the gap lower after the earnings miss, taking us to the lower end of this range, which also lines up with the July 2024 high. Today, sitting there, same range, right? So no change from yesterday's range. We traded closed above the open. That's good, but we're sitting on the 50-day, sitting on support. I think this is still an open question as to whether or not that holds. I think if this doesn't hold, that happening on the chart of Alphabet is not bullish, especially coming after a blow-off top, which is what this is more and more looking like, right? During this period, you can see the momentum declining. Even on the breakout, the RSI not really improving to the degree you'd want to see if that was a strong breakout. And of course, the gap lower really changing the configuration of the chart. We're holding in there for now. But again, I think with similar, that's like a hold rating, right? That's a wait and see kind of chart. All right, let's get to, I think, the big technical news. Certainly after the market, Amazon, big company reporting big earnings. They did not go particularly well. From a technical perspective, what does this chart look like going into today? I would say, at a surface level, I see a lot of things to be very happy about from a technical perspective. The chart is making higher highs and higher lows. The price is above two upward sloping moving averages. The relative strength is strong, showing that it's consistently outperforming the benchmark. The only thing I would point out that is a clear red flag would be the bearish divergence. And again, that's something we've mentioned, I hope, enough that you're getting sick of it a little bit, because that means I'm doing my job of reinforcing the weaker momentum characteristics we're seeing in the new year. It's not good. And it suggests that charts like these are near the end of their kind of rally phase and not the beginning of their rally phase. Let's look at what's happening post. So we're down about another 5%, we'll call it 227. So we're kind of right to the 50-day, excuse me, right to the 50-day moving average. So this is what's happened with some of these charts, right? They're gapping lower, but it's not like we're gapping down to there. Right? It's not like we're gapping down to 140 and we go, oh my gosh, everyone needs to get out of Amazon. Like things going, it's going away. I mean, Amazon obviously pretty established and in a pretty good technical structure. So if we gap down to here tomorrow, that's like the chart of Alphabet. That's still a pretty good chart. And I would say if you step back enough from your monitor, it still looks pretty constructive. And I would argue that's probably what Amazon ends up looking like tomorrow. We'll see how things play out. We'll see what else happens as investors digest the nuances of the earnings, and we open tomorrow for trading. But if that's all that happens on an earnings miss, that's not that bad. Now, if we break the 50-day and break that January low, which means Amazon below like 217 is the alert I would set, then we need to be concerned. I would also say with something like this, when you have a bearish divergence, look at what happens to the RSI after we sell off here. So starting tomorrow, does the RSI hold 40? Because as long as it does, that probably means the technical structure is still okay. But if we break below 40, and that would mean we probably have additional selling after that gap lower, that would be a reason to be more negative. But again, that's not still a pretty good chart, even with a gap of 5%. If that's all we get tomorrow. All right, financial sector. I just want to point out the fact, again, the XLF, similar to previous charts we've mentioned, excuse me, like Amazon going into today's earnings. You have the XLF making higher highs into January and now February, making a new all-time high today, closing above 52 slightly. Little concerned by the weaker momentum, right? So it's all the RSI is getting higher, but not as high as it was at this peak in late November. So a potential bearish divergence as things go on. Undeniably strong relative strength, and I think that's the real story for something like financials, right? The financial sector, if you're ignoring it back here because it's a chronic underperformer and because charts of banks are not doing anything nearly as good as technology, I don't blame you for ignoring financials and going elsewhere. If you're ignoring financials over the last 6 months, though, I would argue you are unfortunately not paying enough attention to relative strength, because if you follow the relative strength trends, which I definitely do, you've seen the emergence of financials, right? And I think this latest run of earnings, they kind of kicked off earnings season 2 weeks ago. And the strength in earnings in those banks really set the tone, at least for the beginning of earnings season, up until we get to all the growth stocks, many of them struggling here. But the relative strength has been there, and you're starting in the new year. I mean, just a fantastic start to the year on a relative basis. So I think the strength in financials is quite real. There are reasons for that outside the scope of what it can go through. I think the shape of the yield curve is a big part of that story. It's the interest rate environment is a part of that story. General rotation away from growth dominance and into other value-oriented sectors like a financials, I think, is part of that story as well. The rotation into more small cap areas where financials are more well represented, I think, is part of that story. But from a simple technical perspective, it's charts like JPM and Citigroup and others just blowing out and continue to make higher highs and higher lows. That is the technical story. Look at the chart of JP Morgan over the last 12 to 18 months. I mean, it's a good chart. And it's a chart that has all of the things that you would want to see as a technical analyst trying to follow long-term trends. Like this is, I think, the case study and trend following are charts like this, right? And it's and there are others out there like Palantir and others that we've highlighted on the show just in the last week. I think are part of that too. But think about charts like this that are working well. Think about what makes them a constructive technical pattern, and that's kind of the secret sauce that I think you should be looking for. Trying to find them back in this phase, right, where they're just starting to emerge in a position of strength, noting the improvement in relative strength, the shape of the moving averages, the pullbacks that are bought, and we make new highs after that. This is what charts like JP Morgan have featured. And again, strong relative strength. And so I'd encourage you, if you don't include relative performance of some measure on your charts, I think you're missing a great data set for stocks and ETFs for sure. All right, we'll finish off with a couple charts. I do see some good questions to answer, but we'll wrap up with a couple more charts here of individual names. Tobacco, the big best performing Dow industry group today. The tobacco group was up the most. You can see Philip Morris, one of the leading names in that group, up about 11% today. We closed just above 145, and that's clearing on earnings, clearing that resistance level. So we kind of had this resistance around 130 to 132. We'd hit that late October, late November, now late January, and today kind of gapping higher. The weekly chart of Philip Morris, which I didn't grab, I don't think, just a nice long-term uptrend phase. And again, don't forget the benefits of looking at the daily chart, especially around earnings. But then look at the weekly chart. Really think about what's happened in the last year relative to the last decade, right? Really understand how these themes have evolved over time. I think that's really, really valuable and a great way to use charting and technical analysis to help you understand the return profile of a particular stock or group. ELF Beauty looked like it was getting dinged in the after hours. Let's look at what's happening here. It's another earnings name today. Yikes. Okay, yeah, down. I was going to say that is correct. It's down over 25%. So that hurts. I've not taken the time to go through the specifics of this stock and what's happened, but a consumer name obviously feeling the pain pretty good. That takes us below the lower end of the page. I was taught back when charts were done by hand. Never confuse the bottom of the page with support, right? And I remember seeing someone with a chart. We had old chart room charts where you'd be hand drawing things to the bottom, and then you'd go below the scale. You'd awkwardly add this piece of paper to give yourself more room to draw the chart going down. It was perfect. Don't remember, just because the chart has a certain range over the last year, you can always go lower than that. That is reality. So don't confuse the bottom of the page with support. Is your quotable moment of the day here. So my point of bringing up the chart of ELF, I did not know how much it was down in the aftermarket. It's obviously quite an earnings miss that we'll be digesting here. My argument is if you're owning ELF going into earnings today, I think at that point you're really ignoring some clear technical warning signs, right? Think about the types of charts that we highlight, the JP Morgans, what makes those consistent gainers and why those charts are ones we want to highlight. And then think about all those things that are not demonstrated on a chart like this. We're below 2 downward sloping moving averages. The momentum is weak, if not excessively weak. The relative performance has been meager, anemic. I mean, the thing's just been underperforming pretty consistently. I mean, even from back at this point where we tried to make a new high and colossally failed last summer, and then we're breaking the 200-day. Like at that point, you really have to question, if you're holding that name, you have to think, is there a reason outside of the chart that is convincing me this is such a good idea? Because from that moment on, there's a behavioral bias that has a firm grip on your brain if you're holding a name like that. And again, I understand not all investors are completely motivated by charts, and you might have other things, but this, the chart of ELF, and again, think about this gap as just the latest move. This is where charts can be most valuable. I know a lot of individual investors think about technical analysis as, getting the next Crocs or the next Meta or whatever, or finding that next thing and buying it like a lottery ticket and it goes up. I learned technical analysis in the early 2000s, and it was all about risk management. It was all about recognizing tech, sweetheart stocks in the late 90s that got absolutely crushed. And the people that I met with, the clients that used charts that just saw the chart is no longer working, The chart's different. It was going up. It's now going down. We need to sell. And they just got out of the way. And then they didn't have to ride these things down to these painful losses. They just sold when the chart told them it's not going up anymore. And I feel like that basic use of technical analysis, arguably its most valuable benefit to your portfolio, is where investors don't want to think. You don't want to think about the selling part of it. You just want to think about buying the next thing. Use technical analysis in risk management. Scan for your holdings that are breaking the 200-day moving average and avoid ELF kind of impacts on your portfolio. I did grab the weekly chart of ELF, by the way, just to show you this broader topping pattern, right? So we were just focusing on that last rotation there. Arguably on the weekly chart, it looks like this weird kind of head and shoulders like pattern, now completely breaking the neckline below the 150-week moving average, really for the first time since the COVID lows. I mean, this has been one. I mean, in 2023, I remember thinking about how amazing this stock was late 22. I mean, look at how well it's doing when the market's getting absolutely crushed in 2022. But what a difference a year and a half makes, right? And so, thinking about examples like this and making sure you recognize those rotations, I think, is the game that a lot of people could probably stand to improve on. Pinterest is actually up a bit in the aftermarket here. Let's see where this is at. Yeah, up about 18% in the aftermarket on earnings, almost to $40 a share. Kind of up here right now in the aftermarket. We'll see what happens tomorrow. But I would say this really, of course, changes the configuration of this chart. Up until today, stock is languishing, unable to get above 34. That was the high from late September, October, November. We're retesting that over the last 2 weeks, the 200-day moving average. So I don't blame you for waiting for some sign of some sort of upside follow through. But when you have a stock like this that's been unable to break out, a lot of times you need that catalyst, right? You need that the juice that's going to push it to new highs. Earnings today seems to be what is happening. Pins is going to have a much more attractive configuration, most likely tomorrow. Final chart here of my list, and I'll take a question or two. McDonald's, right? MCD. Reason why I want to highlight this one. This is one not reporting until next week. It was up about 2% today, but I think this is an interesting one. The gap lower in October, that was the I think that was the last earnings release. Yeah, October 29th. Yeah, so it wasn't. This was actually earlier in October. We see the gap lower, takes us below the 50-day. And then look how we fail to get back into that gap. That's why I often think about gaps as like a support resistance range. I often draw a rectangle on the chart. So I think that line around 300, you can see how that's become resistance this whole time. So as we're regaining that level, I think this stock above 300 all of a sudden means something's different, something's new, and maybe there's a good upside catalyst to retest the October highs, if not a little bit more. I think McDonald's could be a name very much in play going into earnings next week. All right. Yeah, question. It's not really a question. And Charles, sorry if you don't want me to be putting this up. But oof, I didn't realize ELF was down that much. And I will tell you what. Listen, and the only reason why I'm bringing up your point, and thank you for saying that. This is what I love about charts, and I think of after hours movers and just looking at the chart. This is why technical analysis and studying price action is so meaningful. Prices move for a reason. When stocks gap up, when stocks gap down. The chart won't tell you why that's necessarily happening. It's earnings. It's some new AI technology we've never heard of before. It's a military action in some part of the world where we did not aware what's going on. But the charts tell us something is happening. So alerts, scans, a process of going through the charts to recognize changes. I hope that's one of the main takeaways you have from watching my show. And a lot of my content is that I'm a big fan of using charts for what they're good for, which is telling you what's happening and telling you when those things are changing. Stoken, interesting name. I wish you good Stokes as always. These rallies on light volume are alarming. That's actually a really interesting point. I don't show volume a lot, as you probably know by watching the show, but I am a fan of using volume at times and using volume indicators. With certain, again, and I don't know what particular volume you're talking about. There's a lot of different things to look at, but I would say, generally speaking, the argument for using volume is it tells you what sort of momentum in terms of institutional momentum there is behind movements in the price, right? And original stuff I was reading from the mid 1900s, when you first had studies, widely regarded studies on volume and volume analysis, talked about price movements on heavier volume because it represented big influxes or big distributions of institution levels of stock, right? Big blocks of shares that would be going up and down, and that's why you look at block money flow or odd lot volume and use that to determine institutions versus retail. The volume trends generally have been lighter here. And if you look at something like the SPY, you probably see a little more distribution in terms of the trend in the volume. But volume-based indicators, and Chaikin money flow is probably the one that I use the most, is actually saying the volume's okay on the S&P for now. This is a really good way of thinking about volume because it takes the daily volume reading and then weights it based on the directional move on the individual day. So if there's a big move on heavy volume, that really causes the Chaikin money flow to change aggressively. But a big volume day that really didn't go anywhere directionally doesn't really move the needle a whole lot. So it really plays on the relationship between price and volume. Some volume measures are not as bad as you might think, to be honest with you, looking at the trends in volume a little bit over time. Last question. Tony, thanks as always for watching. You asked, is Eli Lilly out of the woods? LLY. That's a great question. Let's bring it up here. So listen, think about what we just talked about with the chart of McDonald's. This is the one I think I was just showing. See this kind of pattern, right? This 300 level, which is the gap down, and then all of a sudden that becomes resistance. That's immediately what comes to mind here with this gap. We can zoom in a little bit to like the last year. You can see the gap lower, and all of a sudden is a new ceiling. And look at how today we're kind of powering above that. Yeah, my short answer would be yes, because today becomes after a higher low, which is good in mid-January. This now makes a higher high. So we're no longer making lower lows and lower highs. We're making higher lows and higher highs. That's bullish. We're above the 200-day moving average. We failed the last time we tried to do this in early December. This time we did not fail. We actually pushed above there. That gets us back into that gap range. I think that's a constructive breakout. Look at the momentum, right? So a stock moves like that, but the RSI is pushing all the way to the overbought region. And that usually indicates an influx of upside momentum. And if you look just on the last year and a half, anytime when I see someone say, "Oh, it's a big move on," and the RSI is getting overbought, don't say, "Uh-oh." That's actually a really good sign. When a stock moves to new highs and it becomes overbought, that's actually a good overbought. That actually means it's beginning something really good. The momentum is so strong, we're actually pushing higher, especially when we've not been overbought for a while. That can often be the beginning of that next move higher. So I would argue, yeah, move like today. Thanks for highlighting that. I would have grabbed that had I seen that configuration that you pointed out, Tony. Thanks for that. Eli Lilly, I think a nice rotation there. Good chart. Folks, that's it. Thanks so much for those great questions. Thanks for watching, those of you that are watching live, and those of you watching the replay on our YouTube channel. I appreciate you watching there as well. Thanks for hanging with me as I get my entire family through the flu. Boy, we're all on the mend, which is good. It's not clear, and I hope I don't have a nagging cough for the next 3 weeks, but I'll do my best to manage symptoms as I'm doing the live stream. But thanks so much for tuning in with me today. As a reminder, the Market Misbehavior podcast kind of firing on all cylinders. We've had some really good interviews last week with Jay Hatfield of Infrastructure Capital Advisors, Peter Bookvar, editor of the Book Report, Jeff Hirsch, editor of the Stock Traders Almanac. Earlier today, I sat down with Steve Kress of Seeking Alpha. He's a quantitative analyst. We had some really good discussions about modeling and quantitative modeling of fundamental data versus charts and technical analysis. I think you'll find it a really interesting discussion. We'll hopefully get that edited and out to you in the next day or two. But in the meantime, have a fantastic evening. We'll have an all mailback episode tomorrow, and then I'll wish you guys a great rest of your week. Have a good night, folks. And remember, it's always a good time to own good charts. Take care, everyone.